Hey guys, Saturday, March 28th, 2020, Eagle Trading, checking in, 3:54 p.m. Holy cow, where did the day go? Um, so I want to talk about where I think the market's headed next week, the stuff that we want to be in, the stuff that we want to avoid, my bigger picture over the next few months. I want to talk about a little bit of fundamental stuff and some different positions that I'm kind of switching up here, and hopefully we'll be able to cover everything really quickly, and how to look for a market bottom. Real quick, here's my concern too. Let's just start with the IWM. Kind of looking at some charts over the weekend, and I haven't really looked at the small caps, but just think about it. The market right now is going through a cleansing process, just as the world is going through this cleansing. It's like the weak and the strong. And I hate to sound morbid because I'm in that older category, but it seems like we're doing a house renovation here, and it's not pretty right now. It's really freaking ugly. Um, and you see that in the IWM. You see that reflected in some of the small cap stocks that have a higher debt to equity ratio. I think you're going to see that in businesses that don't have cash flow. They're going to start to go belly up. I'm a waste broker, and one of my customers I talked to the other day, expecting him to call me and say, hey, I want to reduce my service. We're shut down, this, that, and the other thing. He actually said things were going gangbusters. And I'm like, how is this possible? And he's like, Henry, the guys that we compete with, this mom and pops, are already starting to close down. I mean, 2 or 3 weeks into this, and they can't keep things going. So kind of scary once you think about it, but it's going to happen in the market as well, and you can kind of see that in the IWM. The IWM is in this lower trough consolidation channel from 2016. Okay, we never made a new high and never kept up with the market, the S&P and the Dow, from back in 2018. Never reached that high, and we're into the trough. I mean, think about it. That would put SPY at like 185, 190, which was my target price. So there's definitely a cleansing going on in the market. You're going to start to see secondary offerings to raise cash. You're going to see redemptions on ETFs, and these things are going to put a cap on the overhead of the market, I believe, and still continued downward pressure. We think about historically since World War II, the average price to earnings ratio in the market's been about 15 to 20. And there's been reasons that it's kind of incrementally climbed up from 2015 recently. 2015 was 20, then 2016 22, 23.5, and 17 24.9, and 18, and this year we're around 25. So without this crazy black swan event that's going to actually crush the E on the P&E, stocks pulled back 30% and pretty much pulled back to where we should be historically on the earnings price to earnings ratio. So that's kind of scary, I guess. It's good and bad in a way. The IWM is into the trough, like I said, which would put SPY around 185.90. So either the market's going to continue down, in my opinion, and kind of meet up with IWM. IWM is probably going to push a little bit further down, or you're going to have a reversal where the strong survive over time here, and you're probably going to have an outperform in the small caps. I tend to think the market's going to come down a little bit more, and these guys are going to kind of waffle around and have some downward pressure and maybe get below these levels or try to fight off these levels with some back and forth, looking further back, and I didn't chart past 2014. So it's interesting to look, though, at the IWM and where we're at on a perspective, whereas the SPY is way up here. These charts look completely awkward, too, because S&P pushed through the high of 2016. I'm sorry, 2018, and IWM did not. So a little bit of a red flag. Just thinking about that, just looking at the supply chain, demand chain's obviously hit a brick wall. Nobody's out spending right now. The complete lockdown in the market, and like I said, the market is always a forward-thinking mechanism. It's always trying to digest what they think is going to happen. If the virus is looking to be a chart like this, where you have a big peak like you do in volatility, then a slowly recession, or I hate to say this word recession, no pun intended, but you're going to see it start to subside and flatline. The market's trying to anticipate that ahead of time. And that's another reason, let's get to that too, of why I don't think the market has bottomed out here. And we can use UVXY as a chart. We don't have to use the volatility index because you're going to get the same basic correlation. And let's look at a 1-year daily on the UVXY. Let's do a 1-year daily. And you're starting to see kind of a reverse head and shoulders pattern forming out. which we don't want to see that. We want to see an inverse head and shoulders forming on the right side. And if we zoom in this area, and let's see if we can maybe look at a bar chart, it might look better. And what we're trying to see is the market start to pull to lower levels and the VIX not keep up with the market. That's going to show us that historically on every correction that we've seen over time, I'll call it the A to D level, and I talked about this in this interview I just did on Brawl Street. But with A being extended high peak volatility, extreme fear, and then D being the trough where we tend to stay for long periods of time in market bull markets that have kind of either ground sideways or gradually moved to the upside. So unfortunately, we're kind of in the high C, low B. Hopefully, we won't touch back into the A area, the A quadrant of total fear, which we'd kind of put in this level up here. We'd say this is the A level here. See if I can draw a little thing up here. We'd call this the A chart level of fear. I don't know why my chart's not keeping up. And then maybe the B is this lower level here. And we're kind of waffling around in the C. We don't want to start getting back up into the B. So in a way, you had a shoulder here, then you have the head, and then you have another shoulder here. We wanted this to start failing, regardless of whether the market was starting to see a pullback. It's cycling through its Fibonacci cycles right now. We could see another leg extension to the upside. I'd say I'd give it a 15% chance that we go up and tag the 270 area on the SPY. I tend to think we're going to kind of gravitate and then break the old lows. But for markets historically to make bottoms, volatility starts to go down before the market bottoms, regardless. You could retest the bottom and break it, and volatility did not make a new high. So we don't want to see UVXY start to get up into the 73 area and start to waffle around between the 70 and 90. We don't want to see this elevated volatility. That's not how market bottoms come in. The market bottom is going to be us going down and retesting the S&P 500 lows and the Dow Jones lows, yet volatility can't get back up into the B or lower A levels. It's starting to kind of flatline in here in the C level and then slowly reside into the D level. So you're not going to see a market bottom until we start seeing volatility pull back here, in my opinion. It's also something to look at too when we look at Microsoft and some of the stronger stocks, and we're just going to use Microsoft as an example. These guys got to get above their 20-day moving averages and stay above their 20-day moving averages. In fact, you should start seeing these stocks go above their moving averages and stay there before the market even bottoms out, because they're going to jump out of the gate a little bit faster than the rest of the market is. And I'm going to show you why. If I can get my crap straight here, I'm going to show you why. When you look at stocks like Amazon and Netflix, they're fighting to hold above their 20, and they're kind of going in and out of their 20-day moving averages, which tells me they're ready to go once the market starts to move to the upside, but the market's not ready yet. So anybody thinks that we're going to have a super move to the upside next week, I would tend to think no. And if you think we're going to crash, I would say you're wrong as well, and I'll go into that in a few minutes. I'll try to keep the video short here, so sorry I'm kind of doing two things at once. So let's look at the simple moving average, look at the 20-day, and we'll kind of zoom in here, and we'll change this from a 9 to a 20, and then we'll go into some reasons why I'm kind of changing my position on gold, because I'm looking for more market redemptions, liquidity, which is going to hurt gold out, and it's not been keeping up with gold, and that's kind of got me a little bit concerned. So zooming in close, here's the 20 SMA. We broke above it. We're going to use Mickey Mouse candles here on bar charts. So we broke above it, couldn't hold it, price rejection. At least we have an inside day here. Unfortunately on GDXJ, and this is where I'm kind of neutral on it, and we'll look at the Fibonacci's too. We did break above it on a nice move from the bottom. Good pattern here, right? We broke above it, but not only did we not hold it on the close, but we had an outside day from the low on 2 days prior, which I don't want to see. I'd like to see us at least close inside there if we're going to go into the 20, but not break below 1, 2, 3 days and close literally right on the line from the 24th. So it's kind of leading me a little bit cautious here. In fact, I might flip over to JDST, just looking for a continuation move here, back down if we do see some market pullback. I don't think gold's going to be a safe haven here, and the miners eventually they'll break away from each other. And I am bullish on gold, but I do think that it's going to be vulnerable to any type of market pullback where people are trying to raise cash. Think about it. Just for their daily activities, people, even the wealthy, if you're a doctor, if you're a lawyer, and you can't do you can't have your week to week, month to month paycheck, regardless of how wealthy you are. You're used to a certain standard of living. Where are you going to pull that money from? There's real estate, there's your stock market, and you're probably going to see a little bit of downward pressure there. 401ks, employees not contributing, they have to pull back, to meet their daily expenses. So the top is a little bit capped here. I know, like I said, I don't think we're going to go into these big 2,000 point drops, even if we start to break lows. The beautiful thing about this casino type market that we're in, with the amount of day traders, this is almost like a self-perpetuating mechanism, that there's so much liquidity in the market, so many eyes on the market, so many people looking at the same things we're looking at daily, with support levels on individual stocks. They're buying these levels, and they're keeping the market from doing a 3,000 or 4,000 point drop. And unless things got catastrophically bad on the virus, I don't think you're going to see these huge pullbacks exceed what we've seen already. I think we've already seen the brunt of these massive pullbacks, these long bars that we've seen. And I know we're just looking at GDXJ here, but you're going to see a little bit more subtle ranges, and I think that's a good thing. So talking about strong stocks, so we've talked about Amazon not being able to break up into its momentum channel, but Amazon is also not receded below its 20-day moving average. It can't get it back up into the momentum channel, but it's also not broken its 20. And we talk about the number 4. It's held 4 days over its 20-day moving average. We got 6 or 7 days above the 20-day moving average on Amazon. Just not breaking into the upper momentum channel. It's still capped here. It wants to push through, but it's waiting on the market. There's other stocks that we've seen, PFGC that we kind of quote unquote recommended. Huge rebound from the bottom. $7 to 28. I mean, 400% move. We like this one, and we played this move. But once again, we're hitting the 20. We got to start seeing stocks hold above the 20 for a few days, impervious to the market's sideways or lower action, because those are the stocks that are going to show confidence in the market. We're seeing it in Amazon, but we need to start seeing it on a broader base. We're just not seeing it. And we're in the IWM getting crushed like that, and breaking down to those levels just shows the vulnerability of some of these companies that are, that don't have the better debt to equity ratio. So a little concern on that front. We're going to start going into some individual stocks. Friday was my worst trading day since I started this account 3 weeks ago. I got hammered. I got beat up. I was making all the wrong rookie moves. I was long the market into the big pullback intraday, and we kind of closed close to where we opened up, it looks like, on SPY, and I had a bad day. I mean, it knocked me back on my overall profit. I had a nice gain, and it's a little bit, it bums me out, but Monday will be another day, and I think I'll be back on track. I'm stair-step fashion upwards. Like I said, it's my first real losing day in 3 weeks since starting this whole thing. So I think I'll get back on track. And just looking at the 20-day here on the SPY, we can't even get above it. So obviously some concern here on the broader market. Individual stocks will probably start moving before the overall market bottoms out, and that's what we're kind of looking at for signs. We're looking for volatility to pull back in. We're looking for the stronger names to stay above their 20s, resilient to the market. We're not seeing Amazon break down, luckily. We'll keep an eye on those stocks, but those are the things we're looking at. I also am thinking about possibly taking a position in JDST, and you might get a spike in JDST. I don't like to chart these leveraged ETFs and stuff, but let's take a look at JDST real quick. This is going to be a wacky looking chart. Let's look at because we can't look at these longer term charts. Let's look at the 20-day 5-minute candles and kind of see what we're looking at. Let's get rid of the moving average because that's going to screw things up. And let's see if we can kind of figure out. This cannot be right. What do we have here? 5-minute. Intraday. Let's do a 10-day. 5-minute charts. This doesn't look right, but let's look at it here. So we see a break a little bit higher on, and I think we had a little bit of a, let me see if I can do like a 5-day, 5-minute chart. This is a little bit better. These are really screwed up charts when you start putting up stuff like these leverage ETFs. So looking at the channels here on JDST, this is an awkward cup and handle, but we're kind of making a little bit of an attempt to probably break out to the $3.10 area. These reset after the market closes, so over time they're always perpetually going down regardless. You can't pull up a JNUG and try to correlate it to a GDXJ to the upside, but this looks kind of interesting. Maybe it's wanting to break up into the threes. I think if we did go, and we'd have to kind of keep things measurable here because of the being leveraged. I think if it, your closing stop, since we're talking short time frames here, would be like $1.89, $1.90. That seemed to be the area where it was getting a lot of energy the other day, intraday. If we look at it on a 2-day, and I hate to flip the script here, but this kind of V wedge breakout, and maybe we should kind of put it on a different time frame. And you can kind of see on a 1-minute chart here. Sorry, these things are wacky. Why does it not let me do that time frame? 1 minute. So this seems to be the area where it was trying to break out of this right side V pattern. I'd say this looks interesting on Monday. We'll kind of see how the market opens up in the morning. After market, it got a little bit of a pop too, so we don't want to chase this. But I think we can get low threes out of this. So if GDXJ tries to bounce, or JNUG, I probably exit the remainder of my position and I go long with some type of stop depending on how the chart forms intraday on Monday. And like I said, I hate to flip the script. I'm still bullish on gold, but I think the market pulls back and we get some liquidation across the board on all assets. So that's my train of thought on JDST. I'd like to hear your guys' comments too. Smash the like button like everybody says. See if you like the videos here. I'll get the charting a little bit better. This kind of gets skewed. Thinkorswim is a little bit complex. I'm still getting used to the charting on it. It's been a while. But JDST looks kind of interesting if we do get a pullback here. If it does start to break down on GDXJ lower, I don't know if we want to chase JDST, but if we got a little bit of wiggle room before we get to the low threes, I think it'd be worth it for at least a day or two to be long JDST. And I'll come back with some different ideas too, guys, as well, and look at some individual stocks later.